Please take note of the following disclaimers. This channel does not provide financial, investment, or tax advice. I am not a licensed advisor or registered professional. I am a retail investor sharing my personal opinions, experiences, and lessons learned along the way. Nothing in this video should be interpreted as advice or recommendations. Every viewer is responsible for their own research, decisions, and outcomes. Your financial situation is unique, and you should always consider speaking with a qualified professional before acting on any information. I might be right, wrong, or somewhere in between. They are just my personal perspectives as an individual investor. As such, all content in this video is for education, discussion, and entertainment purposes only. Also note, past performance does not ensure future results. Thank you. Hello everybody, my name's Perry, and I got with me my good pal Paul over here, and this is the Perry and Paul's Coffee and Cashflow. I'm Perry from the PIIverse, and then we got Better Call Paul over here.
Hey,
that we have there, Mr. Ozzy Osbourne.
Hey,
Ozzy
Perry.
Osbourne and Cheech and Chong.
Yeah. Yeah. I was going to say a couple of 70s babies, but you might be a 60s baby.
Yeah. Although my glory time was the 70s, so yeah. I was a baby, so I couldn't appreciate the 60s. So,
Right.
But
Right on.
but enough said. Yeah, Cheech and Chong and Ozzy, yeah, for sure. So
How you doing?
anyways, it's that for those that don't know, this is I think about our third. This is our third or fourth. I can't remember. Third maybe.
This is going to be our fourth.
Our fourth. Okay. So
Yeah.
we've Paul and I started back late last year doing this coffee and cash flow that we've been having that just shoots around topics and talks about what's going on in both of our little ecosystems of passive income investing. Paul and I have known each other for quite a while since the Blossom. Since we got to meet each other in Blossom, we both started our YouTube channels literally on the same week. I think we were 2 days apart from that. So and we both sort of really rose up in the old influencers channel here, as those people know. But anyways, Paul has a channel called Better Call Paul, and I have a channel for his fans and followers called Perry's PIIverse. We're both on the YouTube, and we just have some chit chat that we're going to talk about. We haven't talked since I went on my vacation in January, so I think that was just the week before, early January. So we both thought it was time to actually have a little bit of a chit chat and find out what's going on. So I'm going to pop it over to you for a little intro, and maybe we'll get started then, Paul.
Yeah, Perry, you were off in Mexico, and then in February I was in Costa Rica. So we've been traveling a bit, but we haven't had a chance to catch up on a video.
Right.
So it's hard to believe it's already March of 2026. And I don't know about you, but it's been a pretty wild year so far, especially with everything that's been going on geopolitically. And markets have been wild, up and down.
Up and down, yeah.
Been more, for me, it's been more, I would say more down than up.
Yeah.
I don't know about you, Perry, but I've noticed that anything with utilities, with banks, with oil, all doing really well. Anything Bitcoin related, anything tech related has been beaten up pretty good. But, that's the nature of the market. And, I get messages from people asking me how come certain ETFs are not doing well, and they really thought HHIS was going to perform better, or they thought Biggie was going to do better, or, whatever the case is. I had one person make a comment that I was buying PLTE, which holds Palantir, and he called it US tech trash. It was like, come on, But it's just the way it is right now. Certain sectors are doing better than others. So, the question is, how are you reacting to this situation?
Right. Well, the first thing is people, and again, maybe it's I guess Blossom has brought in a lot of investors that are new to investing, and they came in over the last 2 or 3 years, the last couple of years, maybe not even that, even less than a couple of years, while the cover call ETF market, which has been exploding since 2020, 2022, the cover call ETF market and this passive income investing has been on a roll. It's been on a huge roll. I mean, everything you buy, basically the income just keeps getting higher. You're getting 30%, 40, 60, 80% yields, and they were delivering on them. Well, they were delivering them on them because they were new and they basically, the markets were just feeding into a good scenario. But everyone was trying to tell, like even ourselves, and I won't say we're like 20-year investment veterans, but even we were trying to tell anybody that listened to us is like, the markets go in cycles. There's good parts and there's bad parts. So don't think that because you're buying into, like you said, PLTE, or you're buying into, the round hills or whatever you're buying into, that because it's generating these beautiful yields during the peak, that it's going to continue doing it when the markets are going down. Now, and again, you nailed it right. Like, yeah, you look at some of the more stables, like the finance and even in the energy, which is right now the top performing sector in the entire global market right now. It's the darling right now. But when you see which ones are actually affecting us, it's crypto and tech. Well, those are all high risk, high reward type of sectors. And when you see a market that's actually starting to destabilize, you're starting to see a lot of geopolitical stress, like we're actually, we all are seeing what's happening right now over in the Middle East and all the other things, and the tariffs, and all these are negative, disruptive things that are going to scare the market. And when you scare the market, the first thing that people start moving away from is risk off. They're moving off things like, is the AI bubble a bubble? Which I think a lot of people are now saying, just like everything else is a bubble, eventually AI will be a bubble. I don't think it's going to last, just like mobile phones were not a bubble. They were a bubble. Like they were good. And then they basically realized, well, okay, this is not going to be, euphoria type of thing. Eventually it'll settle down just to being another technology. So is AI run up too high? Has the tech stocks run up too high? Has the crypto been stabilized? And there's just so much that's affecting the higher tech stuff, and that's what we're feeling now. That crypto chill that you and I talked about way back in October and into November, we're feeling it now, and we're now seeing some really rough rides. And again, the cover call ETFs are going to feel that. So you just got to figure out, what do we do about it? Not sit there crying, I didn't know that, right?
Yeah. And I have to say, Perry, that, back in October when the market was booming, technology was booming, Bitcoin was booming, and your portfolio, I know you had your best month ever. I had my best month ever. And you start to get excited about potentially making more and more and more, and right. It's almost I don't know if you want to call it greed, but start to get excited about how much you could potentially make. And then, reality kind of slapped us in the face when Bitcoin went back down again and tech stocks went back down again. And my monthly income has dropped quite significantly.
Right.
Geez, we're going to have to pause until the dog stops barking.
The dog adds ambiance to our meetings. So.
Yeah. But what I'm trying to say is that, like, now my portfolio, so my stock events was projecting, say 135, 140,000 a year in distributions or income. And now it's got me down at about 112. Mm-hmm. Well, 112 is still pretty good.
Yeah.
I would have to get a pretty damn good job to be making $112,000 a year, right? What? So I'm, it's more than double my expenses on a monthly basis.
Right.
So,
you were louder than the dog, so I could still hear you.
Yeah, I think it's fair to say that, even though a lot of people have kind of predicted that we're going to fail. And they just wait until times are tough, wait until times are bad, and your ETFs are crashing, and all of a sudden you're going to be broke and you're going to have to go back to work or whatever the comments were by the trolls. Well, here we are, and the whole market hasn't. I mean, the S&P and Nasdaq haven't dropped that much, but a lot of our Bitcoin's down 50%.
Yeah,
a lot of our tech stocks have dropped quite significantly.
Yeah. And a good example of this is like, oh, your covered calls are down. Look at, see, we said it was going to go down. Okay, so let's use, for example, Hood, Robinhood, HOOD. And it's two big popular covered call ETFs, HOOW and HOOY. It was like, oh yeah, my HOOW is down from 60 down to about 29 or 30. Have you looked at what Hood's price is right now?
Yeah.
This was the stock that was in the 130s, 140s. Is now struggling to be 70 or 80. So it's down because the underlying's down. I mean, at the end of the day, the people that were holding Hood, are they the ones that are throwing stones because, we could just turn around and basically look at them and say, how's your hood doing? By the way, our HUI and our HOW is still producing income for us. What's your hood doing for you? Right?
Yeah.
I mean, like you really nailed it, Paul. It's like I just finished doing a month-end report and I show my spreadsheet. You know, use my big complex spreadsheet.
Yeah.
And if anybody looks at my spreadsheet, you'll see a lot of red, a lot of NAV red, big NAV reds. And one person commented on my page, it's like, you know what, Perry, I like you're saying your strategy, I follow stuff, but when I see all that red on your spreadsheet, it really makes me think twice if this strategy works. I'm going, that red NAV that you see is not paying my bills. That
Yeah.
red NAV is red NAV. Can I tell you how much I'm still generating on a monthly basis? I only need $8,000 to $9,000 a month to retire. Even though my portfolio's NAV is down and my distributions are down, I'm still pulling out $30,000 a month out of my portfolio. So yeah, the NAV is down, but they are still generating. You know, my juicers and my boosters, which are the ones that really have come down, they are still generating about 60% of my revenue. So
Yeah, exactly.
people forget we are not growth investors; we are income investors, right?
Yeah, and this is the time where now you can. I think Adriano from Passive Income Investing always said when the market's down or the market's crashing, this is the best time to reevaluate your portfolio. Okay?
Absolutely.
So my question to you is, if you liked Robinhood, right? If you liked Hood at $130 a share,
Yeah.
do you not like it even better now at 70 that you can buy it cheaper? Right? If you believe in the company. If you don't believe in the company, then why were you buying it at 130? Right?
Exactly.
Or why didn't you sell it at 130?
Yeah.
So
yeah.
for me personally, I've been buying more MSTE, right? Because I believe in MSTR. And
Yeah.
I've been buying a lot more PLTE because I sold a lot of mine at 28 bucks a share. And when Palantir dropped and PLTE dropped down to 16, 17 bucks a share, Perry, I was buying it the whole way down. I just checked yesterday. I think it was at 28 bucks a share. So when it hit like $22, I'm like, okay, I got to buy more. Then it hit $20, I got to buy more. $18, I got to buy more. $16, I'm going to buy more, you know? And I managed to get my average cost from about 22 something down to just over $19.
Yeah.
Yesterday, I was actually in the green.
Oh, wow. That's cool.
Yeah, yesterday it actually popped. I think right now, today it's down again, but yesterday, if I wanted to, I could have got out of Palantir or PLTE, and I would have lost anything. But of course, I'm not selling it. I'm going to get my dividends tomorrow, and I'm going to reallocate into other ETFs.
Yeah, PLTE is a weird one for me because I lucked out on that one. I've lucked out on quite a few of them. A lot I haven't, but PLTE, I think my cost is like $15.90. So if I dollar cost, I'll be dollar costing up, not down. So I bought it when it was a really great deal, and I just let it ride. And it went up to 30, went back down. Because again, people are like, oh, Perry, why didn't you sell off some of it? Well, because at the end of the day, I had already a target weight of it. So again, I could have done, and we were talking about this maybe in the future about this one. We could consider doing some limited swing trading, and that's what you're doing with ENCL. I could have swung trade my PLTE, sold it at 30, made a good, trimmed my gains on it, and moved it to something else and waited. I could have done that, or I could have just set the kind of yield that PLTE is generating. I would have sold it, and then I would have had to find something that generated less yield, because again, PLTE's yield is really good. So I just didn't want to sell it.
I actually bought my first 100 shares the day that it launched. Yeah. And I got them, I think it was about $12.80.
Yeah,
but then it skyrocketed. So the only way I could actually buy more was averaging up. Unfortunately, it was averaging up. And I had my lowest cost shares were in my margin account. Sorry, my non-registered account.
Right.
So in 2026, I moved them over to my TFSA. And somehow it merged all the shares together in my TFSA, and my average price ended up being like $22.
Oh, yeah, you put them together, yeah.
Yeah, but that's okay.
And people are asking because I think somebody even asked in the questions that you were bringing up, or somebody asked this question. It's like, you know what, Perry, you talk about, buying while the markets are really down and there's so many good opportunities. Why are you not buying these covered call ETFs while they're down 60, 70%, like COIW and stuff like that? And again, and as opposed to what I'm doing, my strategy, and I think I mentioned this back to you in January and even in late last winter,
Yeah.
my strategy is the fact that I'm actually trying to build up my anchor positions, right? And the problem is I had too many boosters and juicers. Like again, it was great while the markets were really good, but starting in October, November, when I started seeing the crypto chill, I really, and you said, Adriano said, this is exactly the time when you start seeing some of the stresses hitting your portfolio and seeing some weaknesses. That's when you turn around and do some reassessment and some soul searching and say, things were doing good while it was good, but now that it's actually feeling some stresses from market conditions, am I being overhit by this? Is it hurting me too much? What should I do to counter this? Should I just leave it and let it roll? And the one thing I noticed is that I was too heavily weighted in the juicers. And the juicers, of course, are tech and crypto, because you're not going to make good money unless you're in tech or crypto, right? And so I made a conscious decision that in 2026, I was really going to reinvest my cash towards more anchor positions. And of course, the anchor positions are the ones where you're not seeing major drops in their prices. Like, you're not seeing HDIV crash, right? You're not seeing HYLD crash, or the ones that C-Day crash. So again, it's counterintuitive. I am buying some of the ones that are not crashing, but I'm doing it because I really want to build a more stable income base, which I felt in my reassessment of my portfolio in November, I felt it was too much weighted towards up and down juicers. So are they right? I'm not arguing with what they're saying. You are right. Like, if I'm underweight in HOOW, which is a hood, or if I'm underweight in something like Coin or MSTE, yeah, I would be buying MSTE now because they're currently really good price. And if I believe that Bitcoin's going to go back up again and MSTR is going to recover, then yeah, I should be buying that. It's just that my weight is pretty much near target already. And I have a discipline that if I hit a target, I don't like going over my target weight.
Yeah.
Right? Just for the sake of saying it's a good deal. Right or wrong, that's sort of my discipline of investing, right?
So what have you been buying so far in 2026 to build up your anchors?
So it's so funny because so here's the first thing. I actually made a couple since we talked in early January. I've been doing a lot of rebalancing. That's been a bigger one. Like, I've noticed, you remember us talking last time, I said I'm really trying to build up my cash reserves because I think if 2026's global markets really start crashing or going down, I want to have a lot of what do you call it? Ammunition in the
dry powder.
Yeah, that's it.
Yeah, you wanted to have your dry powder.
I want to have a lot of dry powder so that when the markets do really go down, I want to be able to actually have the cash to do it. So I have been building up cash positions. And when you're trying to build up cash positions, what's the only other thing you can do? Well, if you rebalance, you don't have to have a cash position because you're selling, making proceeds, and then using it for something else. So big moves related to rebalancing have been very much in the anchor space, ironically. A big one that I moved out of just recently is, and it's surprised a few people, I sold all out of HPYT. So, which some people are going to say, well, Perry, why would you move out of HPYT? That's a defensive position. When the markets are going down, the one thing you want to be in is treasuries, right? U.S. long-term treasuries and stuff. And again, right or wrong, I see that this is not your average market conditions right now. I do believe that there's things going on here, and because of the tariffs, because of the geopolitical things, that I think that the U.S. treasuries are not as safe as they used to be, because of the U.S. debt being over 35 trillion and a lot of trade battles and wars where they could basically use treasuries as a weapon by some of the trading partners. So I got really nervous about holding long-term treasuries, so I sold out of them completely, and that was a big position. I had over 4% of that position.
Wow.
And I moved out of it and moved it all into C-Day and moved it into Canadian, more stable Canadian finance and large big business type of thing. So that was one of my big ones, is to move out of HPYT and moved it into C-Day.
I like that move, Perry. I do.
Yeah.
I like that move. C-Day from Hamilton's a great fund.
It
Pays twice a month, which is a bonus.
Yeah.
And it's also 100% not a covered call, right? The
Right.
actual holdings is an ETF, right?
Right.
And then you get your covered call on the leverage, on what, the 25% leverage portion.
Right, and only on the U.S. index. Like they're holding Canadian holdings, but they're not making covered call premiums on it. They're doing it on the S&P or something. They're doing it on a U.S. index to do the 0-day type of work, right? So, and you're seeing the results. Like if you look at C-Day's results right now, C-Day is actually doing really well, even though the markets have been really all over the place. So I felt safer doing that. The other one, which was a really big one, and I created a video on that one too, because people are like, what? When Evolve released SIXY, SIXY, several months ago, a lot of people scratched their heads like, why would Evolve create an ETF that competes with its own ETF that's very successful called Bank, BANK? And so I actually right away said, as soon as they released it, I was intrigued. Again, it's higher risk. I wouldn't say high risk. It's higher volatility. I don't like using the word risk. Because they leverage at 1.33 instead of 1.25, it's going to be more volatile. You're going to get bigger trading boxes because the volatility on it. But I really liked the idea of that higher margin, because I do like margins, and the yield that goes with it. So I decided after waiting 3 months or 2 or 3 months to see, how is 60 doing? Is it as soon as it came out of the gate did it start eroding and declining? And the video shows that it's actually outperforming Bank. When you look at growth. So I decided to not sell out of Bank because I still believe heavily in Bank. Until recently, it was my third largest position. I think at around 8%. I had 8% of Bank. I moved it down. I sold 36% of my Bank and I moved it into 60. So I'm now rebalanced my Bank in 60. Again, tweaking yields within my anchors is what I'm doing. So
I think it's a good question, but I think it makes sense because Evolve has created a new classification of ETFs for their product suite or whatever, right? They have the ultra high yielders now, which is their Biggie, Canny, 60, and Inti. So I bought Biggie and Canny. And I did something similar to you. I thought you were copying me for a minute there, Perry. I'm just kidding. I sold my Bank, I think at the end of last year when it was up quite a bit, and I moved it into Canny, thinking that it's a little bit more diversified because Canny holds banks, but it also holds other Canadian stocks.
Lots of Canadian stocks.
Unfortunately, I think Canny has been underperforming. It's not good. I don't think it's doing as well as C-Day. Or HHIC, or even is it ECI from 9 points?
From 9 point,
I think it's underperforming, and I don't know if it's because of that 33% leverage, or it does have a nice payment. It's got a great payment, right?
It's got a good night, and it's not that bad. Like I say, underperforming if you compared it maybe to like HHIC. I don't actually know. I know they've been rivaling. They actually have gone down a little bit. It could be because of the 33%. I do have Canny because of its higher yield. The one thing I like about Evolve, and that's why I moved away. I did have HHIC, and I actually moved it all into Canny. The reason I did it is one, Canny has 2 pay periods per month. It had higher yield, and the one thing that you got to give Evolve credit where it's due. They almost never drop their distributions. When they hold a distribution, they hold it. It's either the same or higher. It's rare on any of the Evolve positions that I've had where I've actually seen their distributions drop. It's very rare. So, it'll be interesting to see what they do if if Canny maybe continues to say lag a little bit. I won't say erodes. It's not eroding. I think it's lagging. No. If it continues to lag, will they hold on to that distribution? That will be the interesting one because that's not Evolve. Evolve's history has been hold the fort when it comes to distributions, right?
I think they will hold it because the share price, the NAV, is stable, right? It's stable.
Yeah.
It's stable right around $25 a share.
Right.
Whereas something like HHIC has gone from $12 to 14. So there's been a bit of appreciation, right?
Right.
And actually, you got to give Harvest credit. They increased the distribution. It went from 16 to 18 cents.
Right. And that's because they're allowing that more variable up and down, right? I think, and again, I could be wrong. I don't have any communications with Evolve whatsoever.
No, me neither.
I'm a person that I'm focused on income. So I am not looking for NAV appreciation. If Canny can hold its own and stay stable and just run in a price box of say $24 to $26, as long as it holds its monthly distribution stable,
yeah,
I'm happy. I'm not buying, and this is a lot of people. People got to get that growth out of their head. If you're a passive income investor, I'm not looking for growth. I'm looking for income. And if I can see that Canny can hold its own, and yeah, okay, so it's not going up and down. I just don't want to see it keep going down. I don't want to see the erosion. Yeah. I want to see it hold its own. I'm happy with Canny staying stable. I'm actually happy if C-Day just stayed where it is. If it's growing, is a bonus. Yeah. But it then introduces a problem that we've talked about before. It's like, okay, what do you do when you got like PLTE that I bought at 15 and it's now at 29? I'm a passive income investor. Do I trim it? Because that goes against the strategy of passive income. It's like, why are you selling one that's doing well and paying you a good yield, right? So
yeah, I agree with you. I mean, for most of my positions, I do like to just sort of buy, hold, collect the dividends monthly and reinvest them. But as you know, like you have your Athabasca that you like to swing trade.
That's my swinger. Yeah.
That's what I do with the NCL. I've been doing it since it came out. You know, I buy it when it's low, below my cost. I sell it when it's high, and then I just rinse and repeat that cycle. For some reason, it works for me, and I've kind of implemented PLT into it, where I do the opposite. When one goes up, I sell it and buy the other, and then vice versa.
Well, it's funny you said that with ENCL, because when I did that, I did a video about a month ago with regards to how I do swing trading and more of the my science behind swing trading. And a couple of the comments that were in my video, people have said, Perry, you could do that with ENCL. And I totally agree. ENCL is a perfect candidate for income-based cover call ETF swing trading because unlike Athabasca, it pays me nothing. I have to just sit on it and wait for it to appreciate, sell, and then wait for it to depreciate. I get no value. Basically, the investment is dead other than appreciation. With ENCL, you're generating income while you wait for it to go up.
Sure.
You sell it, and you're not making as much, but now you're just waiting for it to go back down. It is a good, slow-moving swing trader, and it benefits you because when you're holding, waiting for it to go back down, you're basically still making some money, right? Because when you swing trade, my strategy with swing trading is you don't sell the entire position. You sell off a part of it, and you hold the rest to generate income, and then you just tweak. Like there's the core part, and then there's the swing trading part. Yeah. So you swing trade the top part, and you hold the core part, right?
Yeah. I don't know if you noticed, Perry, but with a stock or an ETF like ENCL, it's fairly consistent, but every once in a while it drops fast, right? Yeah. Like it was around $19 a share, and it dropped down to 17 quick, right? Yeah. And part of you is almost like panicking, like Jesus, I got 1,000 shares, I just lost $2,000. But it's oil, and it's coming back. So it's time to start buying again, right? And it, just as quickly as it went down, in January it went from $17.20 or something up to $21 in a month.
And you know why? But this is and if you watch my video on swing trading, one of the rules of successful swing trading is to know the company and the sector you're swing trading on.
Yeah.
When I saw ENCL drop from like 1890 down into the 1750 range, I took whatever cash I had available and bought Athabasca and I bought ENCL. Why? Yeah. Because it was all related to U.S. attacking Venezuela. And anybody that's smart and knows about the oil sector knows that what was going to happen there was not what was being promoted on the news media, that basically Venezuela was going to flood us with all this heavy sour oil and Canada's oil sector was going to go for a demise. Anyone that really knows the oil sector knows that was absolutely BS. So
Yeah.
I bought in as fast as I could, and I made some good money both on Athabasca and, like you and I both did, on ENCL.
I should have
ENCL
bought
has a
more.
very nice trading box, an absolutely beautiful trading box
Yeah.
between, well, it's increased its trading box. Now it's at 21. Its trading box used to be around 20 to 17.
Yeah.
All you have to do is wait till it goes down, buy lots, wait till it goes up, buy, sell. It's a good swing trader. It really is. And you
It
generate
is.
income. So,
It is for sure. Back to Evolve for a sec, Perry. I got a question for you because it's something I'm interested in doing.
yeah.
I am doing the opposite of you this year. I am trying to reduce the number of holdings I have.
Yeah.
So I'm constantly looking at my portfolio and, like you, well, actually I think you added a holding. You sold some of your bank, you bought 60.
Yep.
So you added a holding. I sold out of like SPY T and I moved the money into TDAC, which
Yeah.
I think they're both in my anchors. So it was just
Yep.
kind of a lateral move, but
Yep,
got rid of
lateral
SPY
move, yep.
T. Now with Evolve coming out with Easy, I like that
Yeah.
ticker, right? They're
Yeah.
coming out with Easy, but I don't know when they're coming out with it. I would imagine in a few months they've announced the
Yeah.
what do they call it? Where they
Prospectus?
request. Yeah, they when they give the prospectus to the governing body to get it approved, right? So with them coming out with Easy, is it going to make sense to consolidate your Evolve, like Biggie, Canny, 6E, Inti, and just buy Easy?
Well, I have all four now because the other thing I didn't mention to you in January is the idea is I wanted to diversify away from the U.S. economy because I'm really worried about the future direction of the U.S. economy. So not only did I do rebalancing within the anchor position, I've been looking for non-U.S. holdings. And so I actually bought Inti because Inti was an international underlyings position. So it filled in my position of having investments outside of the U.S. So I bought Inti, and of course I traded into 6E. I've already had Biggie and Canny, so I got all four.
Yeah.
So for the question would be is, well, Perry, with Easy coming, are you just going to sell them all and move over to Easy? Well, it would be easy if I would do that. Because now I don't have four positions to manage. I only have one position, and they rebalance and all. So that's a good thing. First of all, because I'm RBC, I get charged for my trade. So that's one thing. Why I would have to pay for trading out of them all, right? And trading into Easy. And of course, remember, unlike you, I've got 4 RRSPs and 2 TFSAs. So when I ever do a trade, I have to do almost 6 trades just to do one because they all basically hold the same thing. It's just
Right.
blended away. The other thing is I do still like the idea in having managed control of each one of the 4. So for example, whereas when you buy Easy, they will, I don't know if they're equally weighting it or whatever, but they decide how much of each one you're going to have. If I turn around and say, no, I still want to be more weighted in 6E and more weighted in Canny, and I don't want as much weighting in Biggie and Inti, I have that better control. So it would be much easier for me to move it to Easy. I would actually eliminate 4 positions and bring it down to 1. That would be a good consolidation. But I don't mind doing the extra work. So for me, it doesn't make sense for me. If I were a new investor on this one and I've never done any of the ultra yielders from Evolve, I would have right away considered going right into Easy because it's like an easy way of having all 4 of them. So it was a good name for it. So,
It was a good name. I guess what I want to know is when they launch it, what's the yield going to be? What's the distribution going to be? Right? Because if I'm going to take a hit, then I might as well just keep holding Biggie, keep holding Canny, and then...
Well, and it'll be watered down. That's exactly what happened with HHIS. You could buy HHIS, or you could have an overweight. I still do hold HHIS, but I also hold positions in those that were yielding higher than HHIS, so that it would actually bring it up. In the case for Evolve, you can almost assure that it'll be a blending between the worst and the best yield.
Yeah.
So at the end of the day, where you've got Inti, I think, is bordering on becoming a booster because it's at 25% yield.
Yeah.
You got 25%, you've got 60 at 22%. Then you know that the Biggie and Canny, you're going to pull it down. So like you said, It'd be interesting where they have. I bet you it's going to be a blend between the worst and the best, maybe about 19-20%. I'm getting more yield holding those 4 than holding that 1.
What's the lowest one right now?
Which one? The lowest I would say would be Canny,
Around 20%?
19-20. I'm just guessing around 19-20.
And Biggie's over 30?
Biggie's over 30. Inti
Yeah.
is around 25. 60, I don't remember 60. I think 60 is around 20 as well, 2021. So
Really, eh? Oh,
Yeah.
so it's high. It's higher than bank, but it's not really much higher. Or It's not
So
as high as.
I think it's 3 or 4% better than bank. So if bank is at 16, it's 21. So it's about 21%. Yeah.
So I'm guessing that Easy might be a little bit higher than Canny.
I think it'll be likely about 24%, 24,
Yeah.
25%, just because Biggie is so big, right?
Yeah.
So yeah. I'm just guessing, but that's what I would predict is going to happen, right? So
That's the only downside, right? Is for me to sell my Biggie to put the money into Easy.
you're
then-
losing yield.
Yeah, I could be losing yield. So we'll have
Well,
to see.
you have to calculate it out. First of all, we don't know what the yield is, so we have to wait for Evolve to do
Yeah.
that. When they do, this is where the idea is you don't make it on gut feel. You basically look at your portfolio and say, and this is what I do. I use my spreadsheet and I actually say, what am I currently generating in distributions, yield and distributions for all 4 of these? I would add them all up and say, what would it be if I took all the proceeds selling all of them right now and moved all that as to equal value easy, and how much distributions would I get from that? And then I basically say, well, okay, if I move everything to easy, I'm going to lose about 43. I go right down to money. I lose about $43 a month, or I'm just saying that arbitrarily. I did exactly that with the bank 60 evaluation. And if you watch my video on there, you see exactly what I did. I said if I sell 36% of my bank and I moved it into 60, and 60 pays twice, and I had to do all the calculations, moving 36% of my bank over to 60 generated me, I think, $140 more a month by doing that, right? So I knew the number, and now you have to make the decision. Do you want convenience and just sit on easy one ETF and let them rebalance it? If you're looking for convenience, you can't go wrong with easy. It's just you're going to pay a yield for that, right? So,
and that's part of why I sold bank. Like I made money selling bank, so I realized the gain. And I went from bank paying, say, 15-16% yield to Canny paying 19-20. So I increased my monthly income. That's why I did it.
Yeah.
And in my mind, I always thought if the banks ever drop, and eventually finances are cyclical too, they'll drop eventually,
they'll
right?
drop.
I mean, RBC now, I think it's over $200 a share.
Yeah.
Right? It can't go forever, right?
No, it can't.
It can't just go up forever. It's got to correct at some point.
Yeah.
Bank goes down below 9, 8, maybe below $8 a share, I'll start loading up again.
Well, and this is the thing. You and I have both been in it a longer time. I won't say long time, but in the cover call ETF space, I've now been in it for over 3 years. You've been in it even longer. I've seen the cycle of bank and call. Two of them that are like, again, I bought call when it was at its low, and back in 2023. I mean, if you looked at call before and after, people are like, why did you buy call? Because before it was really up. I bought it down. So I now know that if call ever gets back down to the number that it was like 2.5 years ago, or if I see bank go back down to $7 a unit, I'll be buying bank. I'll buy bank or 60. I don't know which one, but I'm going to be buying them when they're at their cyclical low. And the reason is because they are sectors and underlines that I trust. Bank has delivered a very reliable cycle. If they go down, I'm buying. Right now, I'm not buying bank because I think it's at its peak. It's close to its peak. It's been a really reliable one. You and I did the same thing. We basically trimmed off our gains and started using them for something else, right?
Yeah. So, Perry, I know you did your video where you talked about, you debated on whether you should reduce the number of holdings you have.
Yeah.
And you kind of decided that you weren't going to do that. You're just going to keep what you have, take all the monthly income, and move it into anchors.
Right.
Where I decided to do the opposite, and I'm trying to trim my positions. Does some of that have to do with, like you were saying, you have 6 accounts, and for every one you sell, you got a fee involved? So was that part of the reason why you decided to just keep things as is?
No, I mean, guaranteed. Anytime I make a major a rebalance, it's always a pain in the butt for me to rebalance because Again, like I said, if I hold bank, I hold it on all, I won't say all six, but it could be in all six of my positions, in all six of my accounts. It's at least 3 to 4, but it could even be more. So whenever I do a rebalance, it is a pain in the rear end. It has some cost. I don't worry about trading costs because $6.95 when I'm doing a $50,000 trade, I don't worry about a trade cost. So
the RBC charges me $9.99.
I know they do, but if you actually, I think they're really being very sensitive. By the way, for anybody that does use RBC, call them up, say you're not happy. If you don't want it, if you don't give me a better deal on my trade fee, I'm going to Wealthsimple. You don't know. They could say yes. In many cases, they will because they really know they're under pressure right now because of the trading fees. Try. By the way, that was an off-topic thing, but if you're at $9.99, call them.
I use my Visa points. So whenever I use my credit card, my Visa card, then when I make a trade with RBC, I just use the points. They charge you the $9.99 up front, so that ends up being in part of your cost, right?
Oh, okay.
I don't know if you know that, but if you, let's say you buy $1,000 worth of a stock, but you pay that fee, they add that on to your actual cost. So your cost per share is a little bit higher than it would have been otherwise.
It would have been, but they're using points because they treat the points as value, right?
No, then what they do is after the fact, about a week later, they deposit $9.99 back into my account.
And then they take your points.
Then they take your points. So
well, and I think I can understand why they do that because it likely is a trading cost fee, and they're basically reimbursing themselves, and they're doing it that way. It's ugly.
So that's why I don't do a lot of trades in my RBC account, but I don't mind doing 1 or 2 a month because I end up getting the money back anyways.
Well, and that's the thing. People turn around and say, "Perry, why are you staying around?" First of all, I don't pay $9.99. I only pay $6.95, so it's lower. But the other thing is, in the grand scheme of things, and again, if you have a very small portfolio, again, I know like my sister and my daughters, they literally have smaller accounts. So when they want to buy 100 shares, paying $9.95 on 100 shares you're noticed. It's a noticeable increase in your average cost. But when I'm doing mine, where I'm doing 1,000 shares or 2,000 shares, $6.95 just disappears. The other thing is also that I'm not day trading. So again, if I were day trading where I was doing trades almost every day, like day in and day out, the cost of doing RBC would be very high because that would be costly. I don't do that many trades. And again, this is where I know we've gone way off topic here, but I do value, as much as RBC and that is a much more stodgy, slower moving broker, they are a full service broker. People think, oh yeah, Wealthsimple, they're so quick and they're so fast. They are a discount broker. And again, this was a posting I just did this week. A major benefit for me personally, because my TFSAs hold a lot of U.S. covered calls. And I do get charged the 15% withholding tax that basically comes with that. My two TFSAs were charged, and again, it's mandatory. It doesn't matter if you're Wealthsimple or if you're the Royal Bank or if you're Scotia. They must, at source, tax you 15%. It's the rule. It's the law.
On your U.S. listed.
On your U.S. listed income generations. That could be company dividends. It could be covered call ETFs. If it's generating income and it's coming into Canada, there's a 15% withholding tax. They have to do that. My covered call ETFs for my 2 TFSAs, mine and my wife's, generated around $20,000 of taxes on that. So they taxed me $20,000. And I said in my post, RBC then says, oh, but hold on a second. You're not supposed to be taxed for the ROC portion of your distributions because that is not income. That is return of capital. Therefore, you're not supposed to be taxed on that. Where Wealthsimple just says, I don't care. I took the 15%. I gave it to the government. If you want your money back from what we overtaxed, you go talk to them. RBC doesn't do that. And the other banks, the major banks, don't do that either. They actually go to the ETF managers like YieldMax. They download their end of year, what's called ROC tax reconciliation report, which says here are the actual ROC percentages that was made up your distributions, and RBC runs it through their back end systems, and I got a check for $7,700. So
I just had a thought, Barry. So now, since you didn't pay tax on the portion that was considered ROC, classified as ROC, when you sell those ETFs,
Yeah.
Do you have to pay tax on it?
I don't, because I'm in a TFSA.
Yeah.
There's no tax on TFSAs, right? If you're in a non-reg, you have to attribute all that, because the fact is that, remember, again, I don't have income generating ETFs in my non-reg, but in a TFSA there's no tax on capital gains and stuff like that, right? So I just basically get the $7,700 back. And somebody asked me the question, well, Perry, if they gave you the $7,700, does that affect your contribution headroom? No, it doesn't, because it's inside. This was a tax that was taxed inside the TFSA. Therefore, it was tax that they shouldn't have charged me in the first place.
Yeah.
RBC has the mature IT and back-end systems to know how to collect that data, do a calculation, and actually give you your money back. Wealthsimple, and I got it confirmed from people that commented in my post in Blossom, said that they've approached Wealthsimple again, and Wealthsimple said, no, sorry, we can't get enough information to give you that data, which is utter BS. They can. They just don't have the systems or the capability or the desire to put that kind of investment into fixing that problem. So you got to know, if you're going with Wealthsimple or a discount broker, you got to know that that is a limitation. Now, you could address that, right, Paul? I just won't buy U.S. cover call ETFs in my TFSA.
Yeah, exactly.
There's your problem. Right.
It's simple, right?
Or you accept the extra cost because you're saving so money on trading fees. Right? It's one of the two, right?
Yeah.
So.
All right, Perry, do you want to get to some of the questions from Blossom?
Yeah, but I didn't even think I answered the question that you asked me.
Which
I forgot.
Well, yeah, I guess I was asking you about your strategy, and so you've decided to keep. Now,
yes,
I know. Well, I think you've trimmed a few positions, but
then I added more. So I'm still at 35 covered call ETF holdings. I actually was at 34. I moved to 35. So the answer to the question is no. I'm not consolidating it, because in that video that I asked the question, my video was, what do I do about my losers? It generates a lot of clicks, right? Because they are losers. I mean, at the end of the day, my Misty's down 85%. So people are like saying, Perry, you've got one that's down 85%. Why don't you just sell it and move it to something else? And the whole video explains, like, why would I do that? At the end of the day, my Misty is still generating, again, I remember the number, but say $600-700 a month. Why would I capitalize my loss and stop generating money that's more money than if I would have moved it to a more safer, lower yielder? The better strategy is hold on to the loser. Maybe MSTR will go back up and Misty will go up with it, and it'll bring the distributions up with it. But instead of selling it, take the distribution money and just redivert it and say, buy the anchors, buy more anchors from the money from your quote unquote losers, right? So my strategy is I'm not going to sell. Another person asked me about consolidation. For example, I've got QQQY and I've got QDTE, right?
Yeah.
That's a good poster child example. Why do you hold two ETFs that literally are almost doing the exact same thing? I agree. If at the end of the day, if one was performing much better than the other, why not just sell it and move it into one or the other? They generate about the same thing, and if I actually sell one or the other, I have to capitalize the loss, of which then it goes into the other. So it's just an inconvenience. Why would I do it just to solve an inconvenience? Let the two cover call ETFs run. I have to find a good reason to sell something with an overlap. And somebody asked that question, well, why do you have an overlap anyways? Remember, it's an overlap of the underlyings. That's not an overlap of the strategy, right? Roundhill runs with their strategy different than Defiance runs their strategy. So yes, there's a lot of overlap on the underlyings, but there's not an overlap on the strategy. So when people say you're wasting a lot of diversification because you have so many that are basically overlapping, they're only overlapping the underlying, not the strategy. And the strategy is what I'm diversifying on, right?
Yeah. Now you're talking about losers like Misty, where you're down, but it's still generating a lot of income, right?
Big income.
But what about, for example, go back to Bank and Sixty, right?
Yeah.
Bank is a big winner of yours.
Yes.
But you can sell it, realize the gain, move it into Sixty, and get even more monthly income. And I think you talked about that in your video, that maybe 6 months or a year from now, you'll make that change.
Well, and that's that's exactly right. I mean, at the end of the day, most people capitalize your losses. No, I would rather I bought these. You and I both, Paul. We bought these cover call ETFs to generate income.
Yeah.
That was our primary purpose. We did not buy these to appreciate value. So when a cover call ETF, like for example, PLTE is a good poster child example. You bought it at 12, I bought it at 15. It generated what was it, 45% yield? I can't remember what the number was at the time.
Yeah.
Okay, if I'm an income investor and I want to generate that 45% yield, when PLTE goes up to $28, $29, it only increased the yield like 5%, 10%. They didn't really. So honestly, that NAV appreciation does nothing for my goal, which is to generate more yield, right? If I'm a growth investor, it did exactly what I wanted to do. It appreciated at 100%. I should have sold it, capitalized my gains, and done something. But if I'm a passive income investor, I'm not buying PLTE for its NAV appreciation. I'm only buying. So the only time I'd actually look at doing it is to trim off some gains and move them to another one that generates maybe even higher yield. And so yeah, so I don't sell losers. I sell winners actually. To capitalize and trim gains, right? So, yeah. So that it's a good question you bring that up, Paul, because it is a reverse thinking to growth investing, right? Because they're all about wealth appreciation. We're talking about income appreciation, and they work differently, right? So, yeah. Okay, so what was some of the questions we saw from the Blossom community here? One, I got to ask you the question, Paul. They were asking you about how your margins are going. I've been watching you too myself. I'm still a little bit on the fence, nervous about it, but I've been enjoying watching your journey through margins. Maybe give us just a quick highlight of how your margin account's going. What are you putting in it? What are you not putting in it? And how's it going so far?
Yeah, so my margin account, when I started, I think in October, maybe the end of October, got my first dividends in November. Every month I keep adding a bit to it, but I'm not going too crazy. I think so far I've taken out about $11,500 worth of margin. But out of pocket, I only put in $18. When I opened up the margin account, I deposited $18. I don't think I even had to do that. But I had $18, I think, in my checking account with Wealthsimple, so I transferred it over. Mm-hmm. And if I was to sell right now, Perry, I could walk away with over $800. Which,
wow, off your $18 investment.
Yeah, for an $18 investment, right? Now, the question that the person was asking on Blossom is, with tech being down and Bitcoin being down, am I going to load up in my margin account on those ETFs, right?
Yes.
But to be honest with you, I really want my margin account to be safe. I don't ever want to get anywhere near a margin call. So I focus on what we were talking earlier before we started this video on defensive, what I consider defensive positions.
Right.
And the funny thing is, it's some of the positions that I've owned in the past, and I sold out of them because I thought the yield wasn't high enough, right? So I moved on from them, and now I'm buying them back again. So like HDIV, right? HDIV. I even added HDIF from Harvest. Mm-hmm. Of course, I have ENCL.
Yeah.
And I decided to buy Oily from, I think it's Evolve, right?
Yeah.
I got lucky. I bought Oily just before the oil sector took off. Right. So I got it at the right time.
Oh, perfect.
And then I put in from Global X, I put in USCL and QQCL, right? So I get, the S&P and the NASDAQ.
Yeah.
I think
that's a good thing you're bringing up. Again, unless you're a real risk taker, if you're playing with margins, you're dealing with borrowed money.
Yeah.
The one thing I would, now again, you could do it through the way you're doing, through actually a margin account. You could also do it the more traditional way of basically borrowing from a HELOC and bringing the borrowed money in and basically hope that you're generating more monthly income than your financing of that borrowed money from the HELOC. So, but you and I are, I think, in the same boat. It's like at the end of the day, I don't want to take any chances with borrowed money. Like at the end of the day, I want to make sure that if it's generating a 14% yield, I don't want it to drop to 4% yield. I want it to be at 14% so it pays off the margin, right? So,
yeah, and I don't want to, don't get me wrong, I love MSTE, but I don't want to put something in there like MSTE at $19 a share, and then a month or 2 months later, it's down to $3 a share. Right. Because then I think you are going to get margin. And actually, they increased MSTE from I think it was 30-40% margin requirement.
Yeah.
They increased it to 100% margin requirement.
Wow. Yeah.
Yeah. So
Well, and that's the thing. Like even when you turn around and say, "But I trust Harvest," it's not Harvest.
no.
It's the underlying that Harvest invested in. And at
Yeah.
the end of the day, you don't look at Harvest. You look at what they're underlying. And anything with MSTR right now is extremely volatile, and of course being under stress because of the Bitcoin scenario. So yeah, you want to definitely want to use anchors. I don't even think I'd want to use boosters. I basically stick to anchors just because.
Yeah. Yeah, I know some people, I think they put HHIS in their margin account because it was a 30% margin requirement. And not that, I mean, again, I like HHIS.
Yeah.
And if you bought it now, it might not be a bad idea, right? If you bought it now because it's low. But some people were buying it when it was $13, $14 a share. Then to see it drop down to 10, you know, it makes your margin account not look so healthy.
No.
So, but yeah, you're right.
I like what you're doing, the idea of using, very stable but boring ETFs like HDIV, HDIF, ENCL. ENCL has some, again, it has more wilder swings because it's the oil sector, but it gives you good yield, and you know that for the last 2 or 3 years that I've seen it, it's always stayed in its trading box. So you feel comfortable because you know that it stays in its trading box, right? So.
Yeah, I was debating on whether I should add, maybe like EQCL or maybe a BMAX. What else? There's a few that I was, toying with the idea of maybe adding some more positions to my margin, but maybe for right now I'll just build up the ones that I have, because I think I already have six or seven, and considering it's only $11,500, I probably have already too many positions. So I think I'm just going to keep adding to the ones I have. But the way it looks right now, Perry, I think my average yield is around 15%. Mm-hmm. And the interest is 4.45%.
Well, that's good.
So, I think.
So the final conclusion: is your experiment over, and your plan is to basically keep it to the same scale? Are you planning to scale up? What's your longer term position right now, based on your experiment so far? An expansion, stay the same, or get out?
Oh no, that's a great question, Perry. This experiment has just started. Yeah, I'm not gonna bail on it. I'm gonna keep going. Gonna keep adding. One thing I like to do is add closer to the end of the month, because if I put another $1,000 or $2,000 into HDIV today, right? It's only the 5th of March. I have I have like another 25 days of them charging me interest. Mm-hmm. Where the way I look at it is, if I wait near to the end of the month and buy that ETF, I'm going to get the same dividend in April. Mm-hmm. Doesn't matter how long I hold it for, but I'll pay less interest. Yeah. And then the other thing was, Sean had the idea of buying it, I guess, after the ex-dividend date, when they pull the dividend out, and if it drops more than the dividend, then add to the position as well.
Right.
But the other thing, to answer your question, Perry, is that I would eventually like to scale this up to the point where it covers some of my bills, where I could actually pull money out of my margin account on a monthly basis, and like maybe make my mortgage payment or something with it. Right. And then I'm just using borrowed money to live off of.
Right. Yeah, that's the thing. You really want to harvest it. I mean, at the end of the day, it's like a free energy machine, but it's not free energy if you can't draw energy out of the machine, right?
Exactly.
So,
I was thinking about trying to have a conversation with Jordan, right? From his, Jordan has got covered call investing, I think is his channel. I think his wife is having their 4th baby in a couple weeks, and he's going on mat leave, and he plans on living off of his portfolio, including his margin account. So I think he's scaled up his account quite a bit. Oh, wow. And I think we're both using Wealthsimple. So I just want to kind of understand better how you pull the money out. Right now, when I get a dividend from Wealthsimple, they put it in my TFSA, say it's a $500 dividend, the money's there. I can do whatever I want with it. With the margin account, it seems like it just takes the dividends and uses it to pay off the margin.
Oh, okay.
Right? So you don't actually see the cash. Same with the interest, right? There's no bill that you owe them interest.
Right.
Excuse me. I think they just add the interest to your account at the end of the month. And then when your dividends come in, they pay off your margin account.
Oh, okay.
Yeah,
Yeah, so
this,
it'd be interesting to hear how you're going to actually get the money out of the margin account. So
exactly, right? But I think if I could scale it up to the point, like if it was 10 times bigger than it is today, right?
Yeah.
I would be paying maybe 300 a month in interest, but I'd be making like 1100 a month.
right,
So maybe I could pull 500 or 600 out.
right. Yeah,
Yeah.
that makes sense. So it's interesting because I know a lot of people are watching your experiment. I know like JJ has basically sort of been sort of like a mentor to it, but it's interesting watching you and Sean go through it and see how you guys as beginners are going through it. So yeah.
Yeah, and I know
Okay.
JJ's got a large margin account, like I think in the $200,000 or $300,000 range,
Yeah.
but I don't think he's actually living off of it. So
No, because that's the big thing. It's you need to again as a retiree, having a portfolio where I can't draw money out of it is no value to me. I'm retired. I live off my portfolio. It basically, once a month pays out all my money out of my RIFs, equal to how much I stated it should do, and so I live off of it. So my portfolio has to actually deliver real cash into my bank account so I can pay my bills. So, yeah.
Harry, are you trying to tell me you're not living off of the fake money?
Yeah, apparently I am. For 2.5 years, I've been living on fake money. So,
It's like a Monopoly game.
well, and again, this is where people are talking about, oh yeah, wait till the markets are bad. People are saying, guys, the markets aren't bad. The Dow's at its all-time high, whatever. But the point is that the ultra yielders that they complained about were the ones that are actually under stress right now. They are because you're investing in very high volatile, high IV type things, and they're right now being hurt. If anybody that invested in crypto is actually feeling the pain. Doesn't matter if you're a growth or an income investor. If you bought Bitcoin at $128,000, you're hurting. Again, it's unrealized. You're just hoping that it's going to come back up. But at the end of the day, anybody investing in those kind of sectors are feeling the pain. The benefit that we're seeing is that even though my NAV is hurting, my income is still paying out. So this is the thing. I'm living off this fake money apparently. My ultra yielders, my juicers, and my boosters are the ones that are generating most of my income. My anchors, if I only was living off my anchors, I would barely make my, if I need 10, I think my anchors are only generating about 14 or 15.
Yeah.
Right? I'd have a very small protection buffer between what I need and what it generates. My juicers and my boosters are what's generating 60% of all my monthly income. So of 30,000, 70% of it, when you add boosters and juicers, are coming from them, right?
Perry, what percentage of your monthly income are you living on?
I live off, I basically set a budget number. So I know we live under that number, but I budget drawing about $9,000 a month out. So
Right.
that's what I draw out of my RIFs. I don't use 9,000. Sometimes I do, but it puts it into my cash, my normal bank cash reserves. So for example, if I actually for 1 month decided to go on a vacation and it cost $2,000 more, for the most part, my cash reserves that built up because I didn't use it for the month actually could pay that kind of bill. So I pull out about $9,000 every month. I generate, February was one of my worst months in a long time at 29,900 or 30,000. So I'm still generating 2 times more than I absolutely need. I'd have to increase my retirement expenditure by 2 times in order to actually get close to how much I'm generating, right? So
It sounds like you're spending maybe just over 30% and then reinvesting just over 60%.
exactly. And people say, well, see, that's why it works only because you're reinvesting almost 2/3 of everything you're generating. No, I invest 2/3 because I don't need 2/3 of it. It's excess income. So why would I not reinvest it and have my income generators generate more income? So this is compounding income. So I don't do it because I have to. It's a good practice to do. And if you want to have long-term sustainability of your retirement consuming portfolio, you want to. It's like having a garden and not weeding it. It's like having a garden and not putting fertilizer in it and watering it. At the end of the day, the portfolio, my income portfolio, is paying my retirement fees. So why would I take the excess money that I don't need and just pull it out, which I'm going to be taxed more on anyways? I would basically, it's better to reinvest it, have it keep growing so that, and this is what we talk about in the future, that this living expense protection buffer increases in gap so that, right now my low is at 30,000. My high back in October was 58,000. So it'd be nice to bring my low from 30,000 up to about 35,000. So even in the worst markets, I'm now only dipping as low as 35,000, and I'm still only spending 9,000. So my protection is not to have a cash wedge. My protection is to generate 3, 4, 5 times more income than I actually need. And you can't do that if you don't reinvest more money. So, that's why I reinvest. So,
You know what? It's a dumb question people are asking, in my opinion, Perry. Because if you were, say, you were a growth investor, and you needed 9,000 a month, you wouldn't sell $20,000 worth of stock to pay yourself $9,000, right? You would only take what you need.
You'll take what you need,
right?
Yeah.
It's
because it's stupid. You'd be taking money off the table. And with a growth portfolio in a consumption era, when you're in consumption phase, which is retirement consumption phase, you're right. If you buy at whatever for $10,000, why would you go and sell $20,000 worth of Royal Bank stock when all you needed was $10,000? Well, no. In their case, they wouldn't sell what they don't need. In my case, I would reinvest what I don't need, because when I reinvest, I'm actually growing my portfolio. All they're doing is slowing down the erosion when they do theirs. Ours, we're actually growing our portfolio during our retirement. Think about that. We're growing our portfolio during our retirement. So,
it's awesome. I'm doing about 20-80, right? I'm withdrawing about 20%, and reinvesting about 80%.
Yeah.
I think that will be good for this year. Next year, I won't have employment insurance, so I might do 30%, withdraw 30%, reinvest 70%, and see how that goes. So
and again, as a passive income strategy, the key part of a successful, sustainable passive income strategy is you need to reinvest what you don't need for living expenses. Now, if you're in the acquisition phase of your life and not the consumption phase of your life, then reinvest it all. Now, people would argue, say, well, then if you're doing that, why not just go into growth stocks? Not arguing that. You could go into growth stocks and say, if you feel you could grow more, and you generally can, you could appreciate the NAV on a growth stock more than you could on reinvesting income, because you're sort of paying, when you do cover call ETFs, you're doing it so that it generates income that you can potentially use. You're capitalizing income is what you're doing. Well, its purpose is not to maximize NAV growth. Its purpose is to generate income. So if your purpose is just to generate NAV appreciation, then growth stocks would likely be a much better approach for you. But if you do need some of those expenses, that income, and again, we talked about my daughters are a perfect example. It's like, then old people only need cover call ETFs. Because I think there was one question in Blossom where they said, I'm 8-10 years away from retirement, and some people are telling me, no, just get out of your cover call ETFs and just buy growth stocks, and wait till you're about 1 year away and then convert them. Not saying that's a wrong strategy. You could easily do that. That's your call. Yeah. But another strategy is what another person said, which one of my two daughters is actually doing in the ages of 30s. She's like in her 30s. She has an income-based portfolio. It generates, again, I'd say it's very variable because she has high yield. So it could go between 3,000 down to about 1,500. That's its monthly range. What she doesn't use, she withdraws out of her TFSA and moves it into her RRSP. She has a good salary, so now the RRSP contribution helps her reduce her taxes. She now builds up her RRSP investments because it's now in her RRSP. She could either buy growth or income. You pick which one you want. If she's in her 30s, it might be a wise thing just to buy growth stocks. And then basically, it's rinse and repeat. At the end of that cycle, when your tax period shows up and you get like a rebate check because you put so much money into your RSP, let's say it's $4,000 or whatever you're going to get back, $2,000, put it in your TFSAs, buy more covered call ETFs that generate more income, that basically now lets you put more contributions in your RSP, and it gets a bigger cycle. So, and then of course, when you finally retire, now your RSP, without you putting any of your own contributions in it, because it all came from income generated from your TFSA, has now got a nice solid RRSP at retirement time. So that's the strategy one of my daughters is doing. Another one says, and again, she has the flexibility that if she has an emergency expense, instead of forwarding it to the RSP, she can actually just pay her bill with it, right? So that's why she doesn't use growth portfolio. She actually has an income portfolio because she could decide if she wants to use it to reinvest into RSP, or she can use it to pay like the hot water tank rent or something like that, right?
Yeah. Tell you, Perry, I'm running out of time, but one thing I'm surprised about for myself was since I stopped working in September, right? And now I did get my last paycheck from work. They paid me out my vacation pay. They ended up sending me, I think it was about a month and a half later, they sent me like $3,000. They considered it 4 weeks notice, right?
Yeah.
Plus I've been collecting my EI. I've actually been living off, I guess, less than maybe I used to spend.
Yeah.
And taking all the surplus and saving it.
Right.
So usually when I get paid on the 15th and 30th from my old job, I was broke. Like I was living more or less paycheck to paycheck. Now, this Friday, tomorrow, I get paid from all my dividends.
Yeah.
I can pull $2,000 out. That's my monthly budget, right? I already have $3,600 in my bank account.
Right. It's building up.
Right? So I've got 3,600. I'm going to put in a 2,000. That puts me at 56. It's 3 times more than I used to have when I got paid.
Yeah.
Right.
Well, I mean, think about it, Paul. People don't. I mean, again, we focus on the growth investors don't look often at the bigger picture with regards to it's to them. It's all about NAV appreciation so that you could benefit in the future when you retire, right? What they don't appreciate is the value of having cash flow at the time you're living now. Like when you're in your 30s, like my youngest daughter, she now was able to buy a house. And the reason she was able to buy a house is because her TFSA portfolio is generating enough monthly income to pay her half of the mortgage.
Nice.
Think about that. As a growth investor, she would not have that capability. She'd be trying to she'd actually be contributing her own income from her employment to try to scrimp and save to bring her RSP up or whatever in order to hopefully when she retires has some money. But she would have been not able to actually buy a house because she would not, on her income, would not have been able to have the cash flow to pay for her portion of the mortgage. So people forget about the idea that cash flow for 30-year-olds, 40-year-olds, 20-year-olds is as critical as having money at retirement. How can you have maybe your cake and eat it? Well, look at these strategies. Again, they all have their positives and negatives, but having cash flow available, like you said, Paul, where you now could get a little bit more extra money from your dividends so that you're like, man, I never had that before, right?
Yeah.
Now I could use it and maybe save it, put it away to build a bigger cash reserve for like a hot water tank failure or a trip or something, right? So
yeah, for sure.
Yeah.
Perry, I don't know if it's going to happen in 2026, but I kind of hope it does. I'd love to see Bitcoin, skyrocket back up to all-time highs.
Yeah.
And and see how our juicers do then. You know what I mean? Our ultra high yielders, how they do under those circumstances, and love to see the income all of a sudden skyrocket again.
Yeah.
But you know what? If 2026 is a down year, it's a down year. We're going to make it through, and maybe 2027 it will happen.
Well, and that's the thing. It'll be interesting to see the recovery, and that's why I actually bought into blocks as well as having Misty and LFGY. Those because they act a little differently. Like I don't hold my hope that anybody holding MSTY or any of the yield maxes, if Bitcoin or MSTR goes up 100%, I don't think we're going to see MSTY and those go up 100%. I think they just don't. They'll be capped to death, so they'll go up, but they will not go up to the blocks. In my opinion, is not that way. I think blocks will. Their structure. I could be wrong, but their structure will likely move a lot more recoverable because they're designed a little bit differently. And same thing, COIW. I think they might be a little bit different. So this is when somebody says, why do you hold COIW and Coney and all these other ones, or why do you hold MSTE and MSTR and MSTY? Because they all have different strategies. At the end of the day, one like MSTY might get stuck because it's capped, and the other one like MSTE might just skyrocket right back up to $25 because it's not as capped. So this is why I hold derivatives or hold investments that they look the same at the underlying, but at the strategy level, they're totally different, right? So Yeah.
Yeah, exactly. All right,
Okay.
Perry. I think we still have to go over the buffer that you were talking about, the
Yes.
income buffer.
Yeah.
So let's get together again next week, and
Okay.
let's work on that.
Okay, and for everybody else, thank you very much for listening. I know this is the kind of podcast. I'm going to call it a podcast, Paul. You stick
Yeah,
your earbuds
sure.
in, you go for a walk. You don't have to watch our ugly faces as you're done. We'll bore you to death for an hour, hour and a half, how long we did. So please do not complain about the length of this video because it's meant to be a long video. So,
That's right. That's right. All right, Perry. Take care.
all right, everybody, have a good
Yep.
day, and we'll see you on the other side.
Yeah. Bye for now.